Welcome to Barchart's weekly series of webinars designed to help you, the investor and trader, to better understand a variety of trading concepts, as well as the tools and pages that Barchart provides for you to support you in a more informed investment decision. So today's subject, implied volatility, ranking, and implied volatility percentile. Experienced options traders will tell you that, or know that there are 6 inputs that determine the price of an option. Stock price, strike price, risk-free interest, time to expiration, dividends, not as much as the other ones, and volatility. And these same traders would also tell you that out of the 6, which has the greatest importance, and they would tell you that, or impact, and that would be volatility. So today what we're going to do is we're going to look at this thing called volatility and its impacts on our option prices and what strategies would benefit from these changes or potential movements in our volatility. Hello, my name is John Rowland, and today my goal is to show you Barchart's implied volatility ranking and percentage page. What does it represent? How we can employ it in choosing a particular options strategy. With me today is my partner and our moderator, Jean Baker. Hello, Jean.
Hi, John. How are you on this beautiful, almost spring day?
Almost spring day, right?
Almost.
We got a few more days to go, but to the official beginning of spring. But hopefully, you're starting to thaw out of there in big Chi-town.
Finally, it's a nice sunny day here, and looking forward to getting some fresh air.
Cool. So, what I wanted to talk about in our here is, for instance, one of our listeners, our regular listeners, Trey, said that good afternoon, and he's looking forward to our webinar, and that learning never ends in this business. And that's an important concept for us to understand, that today, what I want to do is I want to build upon this idea of implied volatility and ranking. And I know we've gotten some questions, pre-webinar questions, and I know folks in here are watching might have some very general, very specific questions about certain strategies or concepts that are related to options. In other words, straddles or strangles or delta neutrals, or how do you use gamma or beta positioning, some things that are very, very specific in terms of options trading. Please have patience today, okay? Try to stay with your questions on topic, and that I promise you, and Jean will promise with me too, is that we will get to more complex strategies, more complex ideas. Our Greeks, for instance, those are coming down the line. Those events, those sessions will be sometime in the future. Today, what we're going to do, as we've done in all of our other segments, is we're going to build that base, that foundation. We're really just talking about volatility in this ranking and percentage process. Okay, Jean? Okay,
sounds good.
All right, good. All right. So just, again, our disclaimer that today's session is for educational purposes and should not be an endorsement to purchase or sell any particular asset, security, or strategy. And it's really important for us to understand risk from a strategic or strategy basis, but also from the individual, the trader standpoint. How you can afford risk, what risks that are suitable for you, especially when we talk about these different types of option strategies. Okay? All right, so let's start with some basics. We're going to talk about something called historical volatility. And this is a measurement of movement of a particular security over a set period of time. We can look at this at different data sets, right, when we talk about historical volatility, to give us a greater perspective. Typically, when we're trading equities or when we're trading using options historical volatility, you will notice that the 20-day historical is kind of the go-to. But we can also compare different historical volatilities to give us of different time frames to gain a greater understanding of price movement. Typically, we would look at something like, let's say, our 20-day, our 50-day, or 100-day historical volatility. Now, historical volatility is going to be used for comparative purposes, and it's not a standalone analysis, right? We're going to use it to compare it to something else. And what we're going to compare it to is something called implied volatility. Now, applied volatility is the market's guess or interpretation of the upcoming volatility of a particular security during the lifetime or the life of that particular option. Now, when comparing implied volatility, now I'm going to use the term IV from now on, so just be aware of that. So when comparing IV to historical, it can give us an insight to if the market perceives that prices or price action is going to be more or less volatile. In other words, we're going to see more price movement. And this will directly impact the prices of our options. Okay. So we have something that is called IV rank or implied volatility rank. And this looks at the options whose strikes are near current price, what we commonly refer to as at the money. And it compares this volatility to the volatility or the implied volatility over the past year. If the implied volatility approaches 100%, then the highest IV over the last year, that's what it's telling us. And vice versa, as it approaches 0, then it's telling us it's the lowest implied volatility over the last year. So understanding where the implied volatility ranks will lead us down a path of what strategies which could benefit from these changes, either in our implied volatility or a continuation of that volatility, or also when we start talking about changes or confirmations of our trends. And so that concept is when we look at strategies of options, we could talk about directional strategies or non-directional strategies. Our IV percentage tells us how many days the implied volatility has been above or below the current at the money implied volatility. Now, what we're going to do is we're going to compare these two together. And some of you might say, well, I'm reading these two definitions and what's the difference, John? Which one is more important, right? And these are good questions, right? Both are important in our process, right? The difference lies in that the differential of our historical volatility and the range of our implied volatility. So we're going to look at historical as it relates to our implied volatility, but also I want to know what is that range of my implied volatility. So for example, if I have a stock, let's say whose historical volatility is, I don't know, let's say 35 or 35%. But the range of the implied volatility is 30 to 40 over the last year, and our current implied volatility is, let's say, 30, then it would rank 0. It would rank at the lowest that it's been over the last year, and our percentage would be 0. But as it compares to our historical, that differential, right, or that range of our implied volatility, it's not a lot, right? And so there might not be a lot of opportunities, or that comparison will give us a little bit different view of that particular stock. But let's say, on the other hand, I have a stock whose historical volatility, again, is 35, but my implied volatility is a range of, let's say, 25 to 100, and my current implied volatility, or IV, is 95, then that's more significant, isn't it, right? Because I'm at the higher end of my range and I'm way above my historical, right? So that could imply that prices or options prices are more expensive, that impact of volatility, right? Now, let's flip this one more way. Let's say that I still need to do a historical comparison, all right, of my components of when I look at my implied volatility and pricing. Well, let's say that same range of 25 to 100, right, of implied volatility, but my historical is 90%, right? And I could have the high volatility, implied volatility, but because the historical is also high, I might get a lower ranking. So, I mean, I'm not going to distinguish one is greater than the other, but I think that the one that we're probably going to rely on a little bit more will be our percentage IVs. That will give us a better understanding of where we are in that range and how it relates to more to our historical. Again, we want to look for that differential, okay? So how can we apply this rank and percentage IV to our options strategies, okay? So looking at the rankings or the percentage will help us determine if the symbols or the securities option prices are relatively high or low. In other words, are they more expensive or are they cheap, right? And this will help us in determining which strategies that we want to employ based on this concept of high or low. And so if we have low volatility or low IV, then we're going to look to strategies where we purchase the volatility, right? We're going to buy the premiums, and we could look for directional movement, right? And some of the more typical directional movement plays would be just buy a call or just buy a put if I believe price is going to go in one direction. Or maybe a little bit more advanced, something called a debit spread. Now, we've done in the past, we have done sessions on debit spreads like bull calls and bear puts, and I would refer to those sessions to get more details about how to trade those. But we can also purchase volatility for the potential increase in volatility as volatility returns to that historical normal. And this is called a non-directional play. And some of those would be something called a straddle is a very common play to take a non-directional trade. And non-directionals, usually what we're going to do on those ones is we don't care where the price of the stock or the security is going to go. We just know that something or some event could potentially increase our volatility. And typically what we're talking about when we talk about equities, we're talking about a news cycle or in very specific earnings, right? Earnings will increase volatility. So a lot of times non-directional options traders will look to put on these plays in front of earnings announcements, okay? If my implied volatility or my IV is high, well, then we're going to look to strategies where our options prices are inflated, right, or bloated, so to speak. And again, we could be directional, right? We could look at looking to credit type spreads. Again, I would refer to some of our previous sessions, our bull put spreads or our bear call spreads, right? Or we could look at non-directionals, right? Again, strategies of options where I don't care where price goes. I just want price not to go anywhere. I want to kind of just slow down. And those would be commonly called strangles, right? Strangle type options strategies. Now, what we're trying to do in those is we're looking for those changes in our applied volatility or RV where it returns to that historical normal. And again, an earnings report, right? We know that earnings reports could be a catalyst for price movement, right? that would lead to an increase into volatility. But then after the earnings report, and typically what we see is that, everybody jumps in with the earnings report, and then after everybody jumps in, what's the catalyst or what's next, right? And implied volatility usually decreases after that news event, right? And if you think about it in terms of old world adages, that old buy the rumor, sell the news concept, right? And so, in other words, if we're going to play implied volatility as just implied volatility, especially when we're talking about high implied volatilities or IVs, this is kind of our contrarians tool, right, for investing. So contrarians like to look for high IV environments, but again, we want to use these in concert with other technical analysis, contrarian technical analysis, maybe something like Bollinger Bands, just to give you an example, okay? All right, and chart analysis or trend direction of the underlying security will help us in our choice of strategy selection, both non-directional and directional, okay? All right, so I'm going to go to Barchart, and here's our main page, and I've gone to the options page, and under the options, here we are at the IV rank and percentile. And what we're doing here is we're looking at the most active stocks in terms of options volume. And that's how it's sorted. It's looking based by volume. And then you can see across the top here, it'll tell you how much the price of the underlying is changed for the day, how much volume, how much options volume, what is your implied volatility of the current at the monies, what is your rank, right? We talked about that. And what is our implied volatility percentage, and then what is the high over the last year. Now, Apple is always at the top or in the top 5 or 10 on this page because Apple is one of the more highly traded options securities. And you can see that, compared to what we're seeing today, the Apple options market is traded almost double, the next one, and certain other securities will pop up onto our screen here, depending on how much options volume. But Apple is usually one that is right at the top of our list. So one of the things that we can do is when we look at our implied volatilities in our rankings, this will give us that concept of what kind of type of strategy we might want to apply. So this is today's IV rank and percentage, but let me go to a few days ago. And so here's the implied volatility or the IV ranking percentage from, this is the closings of Friday. Now notice it does say Saturday, February 20th. But this is the closings of what the end of the day looked like for that Friday. And you can see Apple, again, is one of the ones that is at the top of the list, right? But look over here, we see that our Apple implied volatility ranking and percentage is low. It's in the lower percentile or below 10%, right around 10%. And that's kind of what we want to look for. And so this would say to us that our options are cheap and that the market has discounted or forgotten about Apple. And look at our implied volatility here is 29. So what strategies would we think about employing? We would think about employing strategies where we're going to purchase implied volatility, right? Our bull call spreads or our bear put spreads, or some straddles. Straddles. All right. So let's go back to Barchart. Okay. And so I saw that on Friday, And so here's Apple. Now, again, before I go to the chart here, I just want to show you that inside of each one of our individual stocks or securities, if you are on the main page, you can scroll down and you can see what the implied volatility is for today and the historical. Now, you do see for today, our implied volatility is above our historical, but previous days when we were looking at this setup, what we would have seen was that our implied volatility was actually below our historical for that day, which again, that would be our IV rankings and percentiles. Again, if I wanted a greater perspective, one of the things I can do is up here where it says technical analysis under our technical analysis section, I could click on that and this will go to show me some historical precedents, right? Again, we said that 20, 50, and 100 day, and you can see that our 50 and 100 day was closer to 32%, and that when we looked at that slide where we looked at the volatility from Friday, we were in 28 or 27%, I think it was. Okay, so that told us that in terms of our historical, we're seeing cheaper values. All right, so what could we do? Well, we look at opportunities to trade from the long side of volatility. Whoops. So this is, well, before I go there, let's go back to Apple. And now I want to go to your my chart. I'm going to do a little chart analysis here. And this is what I saw, okay? And let's go back to that date, that February 19th, right? And I'll just show you that that's where we are, okay? So you can see that here we are, February, whoops, a little bit more here. February 19th. And what I saw here was, Apple had been range bound and, chart analysis, this kind of looks to me like, a head and shoulders, right? You got two shoulders there, you got a nice head, and we have a neckline. And implied volatility was low, right? So I'm thinking, hey, if price goes below this neckline, and notice I've drawn a line, and we could tighten this up, but it's around $28 or $27.50. If price got below there, could I see price fall? And I think, yeah, I think we could make an argument on that. Now, to take that trade, right, I'm not going to just jump in it if it costs me a lot of money. But if I could get into this trade for a low amount of monies or a low investment, this might be a good trade. Now, the other thing that I've done is one of the cool tools that we now have in our drawing tools are called Fibonacci Extensions. And what I did here was I did a Fibonacci extension based on the distance of my shoulder to my head, my neckline, and then it shot out the extensions showed me a reasonable target or extension of a price of about 2/3 of my head to shoulders length. And that's kind of where I want to start developing this trade. So I'm saying, hey, below $1.28, I think that very realistically, I could see price go as far as $1.1750, right? Now, I'm just going to move it forward, and you can see that, boom, like in one day practically, or 2 days, we got very close to that target that I would have set. But, price has bounced around a little bit. It came back, test the neckline, and now we're seeing prices moving back down again. All right, so let's go back to our puts here. And what I'm doing here is I'm thinking about doing a put spread, where I'm going to buy a put that is closer to in the money or at the money, right around that neckline, and I'm going to sell a put that's a little bit farther away. So you can see here the 127.50, and this is from Friday, is $5.15, and the 117.50 is $2.05. In other words, I'm going to put this debit spread on for about $3.10. Now, when I do those debit spread scenarios, and we've talked about this before in our sessions for debit spreads, one of the things that I talk about is that magic 25 delta that we kind of like, and that difference. And so you can see my delta for my 117.5 is 20, and my 127.5 is 41. Not at my 25, what I really like, but you know, it's close. If I wanted to be a little bit more aggressive, I could have done the 130 or the 128.5 to get that 25 delta. But for $3 on a $10 price movement, I think that would work for me, right? So $3.10 on that trade. Okay. So let's go to current, and I did, again, if I'm going to buy an options or going to do any kind of purchasing, I want to have a lot more time. Now, I like to go out 60 to 90 days. That's my personal trading. But here I picked the April ones, which is only about 45 days. And so we can look at, here's current prices today of our market. And you can see that the 127.5, right? Whoop, this is the calls, excuse me. Get the right side of the market, right, Ching? So we can see our, whoops, we're just updating our data. No biggie. Right? Our 127s are trading around $7.85, and our 117.5 is trading around $3.25. So what are we up? About $4.50, right? We put the trade on for $3.10. Now it's worth $4.50. So that's a nice return in just a few days, right? But one of the things we can do, which is kind of cool, especially on some of these trades, especially if you're going to do some directional trades, if you get a big price movement in a very short period of time, remember we saw that in 2 days' time, we got very close to our target. And one of the things that I do like to look at in terms of debit spreads is if I can capture 85 or 80% of the total potential profit in a very short period of time, I'm going to do a Steve Miller trade, and you guys know what that is, right? We're going to take the money and run, right? So what I can do is I can go and click on any one of these particular strikes over here. And under price history, I can open up a price history, and that's what I've done up here. I've opened a tab already, and you can see here's the price history of the April 16th 127.5 calls, and it shows you what excuse me, those are the calls. Let's go down to, I want to go and do puts. I apologize. Let's go back to stay with me. I apologize on that one. I don't want the calls. I want the puts. All right. Oops. Something's going on here. Hang on. Oh, here we go. Yeah. Knucklehead. Okay. All right. Go to my price history. 127.5 puts. And here we can look at our price history. Remember, we were talking about February 19th. We purchased that put at around $5.30. And in just 2 days, we got a high of almost $11.90. And if you look about 3 or 4 days out, our opening price was $9.30. But think about this: in 2 days, we've over doubled the price of that particular options. Now, would need to go back and look at my other strike, the 117 strike, and look at its history, right, to give us, that perspective. And here we can see, that day when we had a high of 11.90 on the one put. Here we see the other put was, $6. So 11.90 minus $6 is $5.90. We're trying to capture about $7 worth of profit, right? A $10 differential that we paid $3.10. Well, that's pretty close to about 82% of what we would have captured on this trade, and that only happened in literally like 2 days' time. So there would have been an opportunity for us to exit that trade and have a nice return on our trade over this period of time. Now, one of the things about credit spreads and debit spreads, all vertical spreads in options, in either low or high volatilities, is that they take time, right? They take time to unwind, and a lot of times you're not going to get to that potential until we get to closer to expiration. But so right now we can see that if we go back to our chart, right, and we look at current prices, right, again, we said that we're close to, about $4.50, right? So we're getting close to that total potential, but we're probably going to need to wait until we get closer to expiration to get that maximum profit, and we probably need price to be below that second strike. All right, so let's go back to our IVs. And so the one that popped up today that I thought was kind of interesting was Boeing. And again, look at our percentage and our ranking. We can see that we're in that low part of our IV. So again, I want to have that historical, right? I want to know, is this low, right? My 46, right? Now my historical high is 200, over 200. But if I go to Boeing and I look at that relationship, yeah, sure, we see that our implied volatility is low compared to our historical. So there could be a reason for me to look at Boeing to look for some purchasing. Now, I might just do something simple as buying an in-the-money call, right? Something that would be, an easy way to take advantage of price volatility if I thought Boeing was going to go up or to go down. So again, I might look at a time frame that's a little bit greater than just a weekly, right? Maybe I'll go out to, maybe out to May, give myself time, about 80 days, 79 days. And I'm not going to be afraid. Don't be afraid to look at, especially when you're looking to buy volatility, don't be afraid to pick strikes that are just slightly in the money or right at the money. Now, I know that some of you might get a fearful of this, say, hey, I'm going to buy a $235 call if I believe Boeing is going to go up, and I got to pay $20. That's a lot of money, right? I mean, I know that seems like a lot of money, but think about it. That $20 or $2,000 to buy this option allows me to take control of a stock that's worth $235. Or if I had to buy 100 shares, that'd be $23,000. So I'm getting a lot of leverage here. So don't be afraid to step up and purchase. If you're going to buy volatility, be closer. I know a lot of folks like to look at, hey, if I'm looking at cheap volatility, I might look to buy something that's out of the money. Well, a lot of times what happens is that those out of the money prices, they could have higher volatilities, and you won't appreciate from that returning back to normal. Okay, so that's kind of a nuance of strategy of going long our implied volatilities. Okay, so let me stop here. I see a lot of questions popping up before we go to the next part. But let me go back to Boeing here for a second. All right. So what could be a catalyst that, and these are things that we need to think about when we look to buy implied volatility. Now, here's our chart. I mean, this kind of looks like a nice uptrend. And again, let me just go to give you guys a big picture. This is why I was thinking more towards calls than I was thinking about puts, right? Nice, looks like an uptrend. And, you know, we're getting close to, looks like we're breaking out of that most recent high, right? But what could be some catalysts that could drive our options? Again, we talked about earnings. Now we can see that Boeing just came out with earnings in January. So, you know, any of my weekly options right now are probably not going to have a catalyst, you know, in terms of earnings. But that May one, right, earnings are on a quarterly basis, that one could appreciate from that potential earnings announcement that it could come down the line. Okay. Look at unusual options activity to give you a clue that maybe you're going to see an increase of price action or volatility, right? Okay. So let me stop here for a second and look at a couple of your folks' questions. I see a lot of questions popping up here. So Andre asks, is a decreased IV implies that the market anticipates that the stock price will go up and vice versa? No, a decrease in implied volatility means that the market is telling you that the price action, not necessarily up or down, but the price action, that vibration is going to become less, right? Usually when you see shrinking implied volatilities, it's the market's predicting that your stock or your equity is going to be range bound, okay? So Vic asks, I find stocks with high volatility with no specific news, and the volatility does not come down for a while. How would you trade this? So we'll look at that in a second, Vic. So Anna asks a great question. She says, what do you would consider low vol, less than 30, or are there other factors involved? So Anna, again, it depends on that historical and that range. So a 30 could be a low volatility if that stock's implied volatility or historical volatility's range is 30 to 200, right? But if we have a stock whose range of implied volatility, is 15 to 50, then 30 would be right in the middle, right? So it depends on your historical and the range of your implied volatility, okay? All right. Okay. So I do see a few more. We'll come back to those questions in a second. All right. So what can we do for high volatility, right? Selling implied volatility. So let me go back to our IV page. Now, let me stop here for a second in terms of selling implied volatility, right? So we can look at directionals, right? We could just do an outright naked put or a naked call. You know, maybe use the protective stock at a break-even price. We can look at non-directionals as well. But selling is a lot more difficult in options, and certainly in high volatility scenarios, right? For a variety of reasons. But first of all, that and foremost is that selling these outright, right, and naked puts or naked calls has a lot greater risk, right? I'll give you a great example. Last week, about a week ago, GameStop, which has been one of those stocks that's been crazy as recent, GameStop was trading around $40, and someone came in and bought $16,065 calls. And on that day, this was with 2 days to go in that option, 3 days to go in that option. It was a weekly. Those calls on the beginning of that day were worth about 2 cents. And by the end of the day, they had bid them up to $35, right? So somebody who comes in and says, hey, that implied volatility has gotten really, really expensive. And I think that implied volatility went to like 500% or 1,000%. I'm telling you, it was a crazy number. Just don't jump in there to just sell the implied high volatility because you think, oh, it's going to come down. The next day, GameStop gapped up to $150. You would have been out $9,000 for options on that gap up. So again, when we look at selling implied volatility or selling historical volatility in terms of our rank and percentage, I want to take into a couple considerations. First of all, I'm not going to do nakeds, right? I'm not going to just sell it as is. And I'm probably going to do some type of a credit spread, right? Now, again, as I said to you before, credit spreads tend to take time. And that's because when you get into these high IV environments, your deltas will come closer together, and that you won't get a lot of price, or when you do get price movement or implied volatility movement, both your long and short strike will move in tandem. So it takes a longer time for you to do that. So what I wanted to do was talk to you guys about a little bit more of conservative approach in terms of looking at selling implied volatility or IVs where we have a higher environment. And that would be where I'm trying to generate income from equities or securities that I already own. In other words, kind of a covered call strategy. I already own the security, and now prices appreciated or depreciated, and my implied volatility has gotten super high, and I'm going to look for an opportunity to sell that. Now think about it like this, right? You've owned this vacation home if you had it in your family for a while, and over the years the value of that home has appreciated, and then now your family's not going to that vacation home anymore, and you want to rent it, right? You want to start renting it. So here we're going to create or generate some income from renting out this home. Now, what's cool about options is that I can rent my home. I can determine the length of time that I will rent the property for, and I can also determine the price that I'm going to rent it for. The caveat or the one stipulation is, though, my renter, after that week or month that they've rented that home, they might take the option to buy that home away from me. But they're going to buy that home away from me at my full ask, which is kind of a good thing, right? So looking at selling IV environments, high IV environments on a covered call basis, in other words, an asset that I've already owned, to try to generate income. If I get that assigned away from me, that's a good thing. Don't worry about it. You still might have an opportunity to get into that, right? So one of the ones that I was looking at just recently was, I think it's an R, excuse me, is Fisker, which is a battery company, this new technology. And again, just full disclosure here, this is a company that I do own, and it's in part of my portfolio. And what I was thinking was, I'm long down in this area here, that $15, $16, that I'm getting close to doubling my money in a very short period of time. So again, I used that Fibonacci extension tool. I looked at the last leg movement, and then I did an extension, and you can see that I came pretty close to that 32. So what I looked at was selling $32 calls and capturing that premium, is in anticipation that, hey, if price went above $32 and I got exercised, so be it. But those 32 calls were giving me a few dollars of extra profit. So I'm really wasn't selling $32. I was selling like $35, right? Which was a nice thing, right? I'm going to double my money in a short period of time. So that's kind of where I want you guys to think about for my junior traders. If I'm going to look at high implied volatilities and looking to take advantage of those, is look for that kind of cover call scenario. But you could also look at those credit spreads where we limited our profit by capping our risk. Just be aware that those ones will not play out as fast as we saw in the Apple scenario where we're buying volatility. Okay. So the one that popped up today that I kind of noticed was where is it? Oh, here it is. Rocket Companies, right? Right, it's a $29 stock. The implied volatility is 175. 174.989. The rank is low, but the percentage is high, right? And the 2-year or the 1-year high is 200, right? So what we could be seeing is that we've had a news event or something could have sent this stock on its way, and now we're seeing this bloated implied volatility is about to return to maybe what is normal. And so here's Rocket, and sure enough, that's exactly what we see. We see that we did have this big spike, right? And again, if I go to my options overlay, which is a cool little feature, right? We did see that this historical was high. Now that historical was made just a couple of days ago, right? So we are seeing our implied volatility starting to fall. And this is what we want to do when we look to sell these high IV environments. We don't want to step in front of that freight train. We want to see that contraction, that return to what is more normal, so to speak. In this stock, it might not be more normal, but you can see our 50-day and our 100-day. A normal is about 150 to 120. Again, a high volatility stock, right? But what could be that catalyst right now? I don't know if it was an earnings report. This earnings report came out in February 25th, and I'm sure that didn't affect prices yesterday, that earnings, right? So there might have been some other news story based on this stock. And one of the cool things is you can go down here and look under news, and in here you might find some news story that could lead you to finding out why that price jumped up. And it could just be, out of the ordinary, or maybe some unusual options activity. We would look in there. But there is an article here that says implied volatility surges for a Rocket Company. And I thought this was kind of cool. This is really an article basically talking about what the things that we're talking about today. That it hit on our high IV page because the March 19 calls, the $15 calls, reached the highest implied volatility. That volatility was yesterday, right? And it talks about what is implied volatility, what our analyst thinks, and what kind of options trades to look for. So I thought that was kind of interesting that this one popped up and there was some action on that. Okay. All right. So selling, let's go back to selling this IV where we're in a high IV environment. I want you to the caveat here is I want you to make sure you look for and be careful that if you see volume increasing in your options and you see your IV increasing in your option, there's a good sign that somebody's buying options because they're aware of some information that you're not aware of, or information that you've overlooked. Again, it could be options or dividends or something to that effect. And that's why the unusual options page is a great page to help you dig into that process. And what they're really doing is they're predicting that there's going to be a news event or a corporate event, maybe even beyond earnings or dividends, right? A change of regimen, or maybe a takeover or something like that. So again, don't step in front of that freight train. Let's wait for our IV to start to contract and return to what is more historical. Now, if I was going to do this one in terms of a strangle, which is a typical type of scenario where we wanted to sell and capture premium, I probably would strangle this whole candle, right? I'd probably strangle like a $42 or $44 or $40, and on the other side strangled $25. I mean, that's a huge range of price for a stock that was only, $20 a few days ago, and then try to capture that premium. Now, I looked at it; it wasn't a great example, so I'm not going to spend a lot of time on that. All right. So let me just kind of break something down for you. So if I'm looking at low volatility and I can do single legs or multiple leg strategies. Some of the guidelines I'm going to give you is, if I'm going to do a single leg, let's say I'm going to buy a call and I think prices are low, right? Let's say stock prices have come down dramatically in a short period of time, and I believe that stock is a good buy, right? But I don't want to put that monies out to buy the individual stock, playing the options. Again, I talk to you, don't be afraid to buy, calls that are, at the money or in the money, right? You're going to get that leverage. You're going to control that same amount of stock for, a fraction of the cost. Right? I want to make sure my delta is at least 50, right? In that 50 category, right? I'm not going to worry too much about my Vegas. I do like to see positive Vegas there, and you will. Theta, right? Our time decay. If I'm buying something, I want more time. So I want to look out, 60, 90 days, okay? If I'm going to do a vertical spread, where I'm going to buy, let's say, a bull call spread. Again, remember we talked about that net delta. We did that in the center. We're going to look for that net delta of 25, as well as, that greater time, longer period of time. If I'm in looking at credit spreads in a, and I want to sell puts, right? Right, I think price is going to go up. On a single leg, right? I want to make sure that I'm out of the money, right? I want to make sure I'm pretty far out of the money, and my delta is at least 25. If I'm going to do a credit spread, right? Again, I'm going to do out of the money credit spreads, but again, I'm going to look for that net delta of 25, okay? If I'm looking to sell, sell in a high environment, sell, let's say, covered calls, again, I don't want to just sell cheap premiums, right? I want to make sure that I'm going to get some bang for my money. And again, I could sell out of the money, but now when we're selling, we want that theta to help us. So we're going to look inside of 60 days, maybe even inside of 30 days as our time frame of our dating our options. And again, I want to be probably out of the money, right? So if I'm going to do a credit spread, I want to make sure that I get that net delta. All right. So keep those things in mind in terms of high volatility and low volatility, watching your deltas. Now, the other thing I did talk to you guys is that there is another Greek, which is called Vega, and I am getting close to the top of the hour, so let me see if I can do this kind of quickly. Vega is the amount of the option price changes when implied volatility changes by 1%. So if you believe that there's some type of an announcement that's going to increase your volatility, let's say an earnings report, you want to use longer dated options. We've already talked about that, but we want to make sure that we buy a option that has a high Vega, right? Because we want to appreciate with that increase of our volatility, right? And so we want to look for it. And so typically that, the greater the time, the greater the Vega. At the monies will give you greater Vegas too. So keep that in mind. And, if I was going to give you guys a flip a coin one way or the other, and I think, and you talked to a lot of experienced traders, most experienced traders will tell you that they're more inclined to look to buy volatility than they are to sell volatility, and that is because of those greater risks that I've laid out for you. All right, so let me answer a few questions here before our time is up. Gene, is there any questions that are popping up that are kind of common?
Well, a number of people have been asking me if there's any way to screen for high or low IV. And yeah, that really is a whole topic in itself for maybe another webinar that we can run here. But our option screeners and even the stock screener, if you're looking for summary options data, we have recently added a number of filters that allow you to do such types of filtering and screening. Just maybe look for the options overview filtering segment in each of these screeners, and I think you'll be able to find that there. And yeah, we will come back and maybe do a separate webinar on the new options filtering in the future. If you do have any questions, I do suggest you email support@barchart.com, and they'll be able to be happy to help you out with that as well.
So what Gene is showing here, and my bar chart's kind of slowing down here, it's just my internet right now, is, I can come in here and screen and screen on any list I have, right? And here's a stock screener. And I can come in here and under the options overview, right, I can go in here and pick, does it have options? What's my implied? What's my rank? What's my percentile? Even to, look for open interest. And so one of the cool things that it can do is, as Gene has said before, is we can create screeners based on that. And one of the screeners that I do have is an IV screener where I can take a list and then have those IVs already popped up. So great questions, guys. And I'll look under my, here it is, IV percentage. And let's see if it shows. So yeah, and so here you can see my rank and my IV and my implied, and I put in my historical, which is my range, and my options for that. Okay, so yeah, that's a good question. All right, let's see.
There's one other, John, while you read through the questions I've sent through, one other that has been coming up a number of times is, when are we going to do a webinar on unusual options activity? We're working on it. We've got that in our schedule. We're not going to release a date until we have everything locked down yet, but stay tuned because that's coming up in the near future.
Yeah, that is probably going to be our next options session. So that one is definitely, it's in the books. We just got to make sure that we put everything together. So Dean asks, why do you not look first at put spreads in the Apple example? I did look at a put spread in the Apple, and wouldn't it be easier to analyze directionally? So Dean, I don't know if you missed what I was showing you. Was I showed you a head and shoulders where I believe price was going to break, and that's why I did. I think what I made a mistake was I went to the calls instead of going to the puts, and so I apologize for that. So Ted asks, the 25 delta target, does that apply to only the spreads or to all strategies? So yeah, Ted, I think, I like to see the 25 delta spread in my spreads, but if I'm going to sell an outright naked put or a naked call, yeah, I still would like to see at least a 25 delta or greater. If I'm going to purchase them, buy volatility, I'm probably going to look for like 50 deltas, right, or 45 deltas. Okay, so great question there, Ted. So David asks, what determines how far out you buy strikes? So I'm assuming you're saying that we're going to buy volatility. So David, don't be afraid to look to buy calls or puts if you are in a directional options trade where you're looking to buy volatility. You believe in increasing. Don't be afraid to buy at the money or even in the money, because you're going to get, in the long run, you're going to get a lot more bang for your buck. Your deltas and your Vegas are going to be higher, and so every increase in your percentage increase in your delta. A lot of times, if you purchase a out of the monies, right, you might get that price movement, but because that one is farther out, that implied volatility is already much higher. Remember, that's that prediction of it. All right, so good questions there by Dean, Ted, and David. All right. So DS, yeah, we don't buy volatility if we think it's going to revert back to normal, right? We sell volatility if it thinks it's going to go back to normal, right? And that's why we want to look at that comparison between our implied volatility and our historical, right? So when our implied is below our historical, we're going to look for buying opportunities. When our implied is above our historical, we're going to look to sell. So I hope that clears that up, right? Okay, Theodore asks, how do you factor in the greatly increased risk that comes with longer term timeframes and options pricing? Yeah, I mean, that is a risk, right? And again, there's that leverage concept, right? If I'm just doing a one-legged side, I'm going to, have some very protective stops, either in the market, or if my stock or something comes close to my where I'm going to tap out, right? In other words, I'm invested $20 in a stock in terms of price, and I lose 10 or 15% of that. That might be in the price of the option. That might be a sign that I want to get out of the trade. So again, Theodore, it's really about each individual trader, how they manage risk, and that those credits, debit spreads is a good way to manage risk over a longer period of time, because it caps your risk to the downside. And yeah, that's a great question in terms of equity, especially the way. So let me take that one step further, Theodore. So stocks have a lot of gaps, right? They gap overnight and they have big gap movements. So indexes don't gap as much. So Theodore, one of the cool things you can do to manage risk is trade the right asset. And so indexes are a great opportunity to trade longer periods of time, because you don't get those crazy gaps like you do in individual stocks. So look into that, all right? Yeah, so Richard asked, in the case of the Apple, I thought you bought IV. Yeah, the IV was low, right? It was, the rank and percentage were right around 10 or below. The historical was, I think, around 36 or 35, and the implied was around 28. So yeah, it was low. And the chart, in looking at that chart analysis, looked like it was going to be selling, okay, right? It looked like it was going to break out of that range, right? Again, I'm thinking that if price got lower, it would go in the short term, go a lot lower. All right. Okay. So where are we at, Gene, on time? We're just a little bit over. Okay. So let's do this. Let's go here. I do want to say that if I didn't get somebody, I see a red flag here. Some Tom Kelly, who left the room, did say that Reddick is the rocket is the Reddick play for today, which is kind of unusual. It's funny. Anyway, so for next week, we're going to talk about global markets and opportunities to diversify your portfolio. We as Americans here in the U.S., we become heliocentric, I think, a lot of times in terms of our investing. And we're going to look at opportunities to trade ETFs and securities outside of the U.S. that could appreciate as monies flow around the world to look for greater trading opportunities. So hopefully you guys will get an opportunity to join me. And a reminder that all of our sessions are recorded, and that this is where you can find those recordings. Jean, do you want to add anything before I say goodbye?
Just a couple of things. A lot of people are asking, can I review this webinar again? You will get an email a little bit later on this afternoon with a link to the recording, or John has our webinar archives page up, and it's on that page as well. And the only other thing I want to mention is a lot of the data that John went through today, you can see on the website, whether you're a member or not. But if you're looking to do some of the more advanced analysis, looking for high or low implied volatilities, you really should look at trying out our Barchart Premier subscription. That's where you're going to get the most powerful screening opportunities, and there John has a slide up there for you. Our basic membership is free. Barchart Premier, we have a free 30-day trial. So try us out, take a look at all of these options, screeners, and other things that are available for you with Barchart Premier. That's about it for me, John.
Well, I want to wish everybody to stay safe, be healthy, and the good of all trading. Thanks, guys.